So welcome back after this break, and now we are going to discuss about the last two concepts of the forward contracts. One is the early delivery and the other one will be the late extension. Late, everything will be late, like late delivery, late extension, on late cancellation. So we will first go with the early delivery concept. This is very important. Come to the let me just close the rest of the items. This is early delivery. I will just take this example once again. From the start you will be able to understand it. Let me just confirm once again where we were about to sell the foreign currency. Acha, importer. Just understand. Let's take a situation that after 3 months there is an importer in the question. Importer. Okay. So what will be the purpose of that importer? We are going to look at it from the angle of the bank. Okay. We are the bank. Now importer will come to us today and will ask for the agreement in forward contract. He wants to buy foreign currency from us. And the due date is 3 months from now. Let's say, for example, we have entered into a contract with him. It will be a forward sell contract for the bank, because bank will sell the foreign currency to this guy and he is going to purchase from us. And the rate of contract is, let's say, 50. At 50 rupees per dollar, we are going to, at 50 rupees, we are going to sell him every dollar. Okay, sir. But think from the angle of the bank. This is a forward sell contract for the bank with the customer. But the bank will not take the risk of foreign exchange rate, changes in the foreign exchange rate. So what the bank is going to do, bank will cover immediately after entering into a contract with the importer. Bank will cover itself immediately. Now what do you mean by covering? Bank agreed to sell the dollars to this guy, but where do you think the bank is going to purchase the dollar from? It will be from the interbank market. So immediately bank will enter into a forward buy contract with the interbank, like other bank. Now bank has entered into a forward buy contract. That means bank, after 3 months, bank will buy those $1 lakh. Let's say, for example, it's $1 lakh. So bank will buy $1 lakh from other bank and it will sell it to this customer. So making a clear cut profit of, let's say the buying rate is 48. 48. That's it. So when the importer came to the bank looked at the interbank rate and bank saw that it will cost us 48 rupees for $1 to buy it from the interbank market, and that's why after keeping 2 rupees of the profit, bank quoted him 50 rupees as the rate. So after 3 months, $1 lakh will be bought and sold by the bank, and 2 rupees per dollar will be the profit of the bank. Do you agree with this? Okay, sir. So this is the original contract. This is the cover contract. Bank has made itself risk, like bank has hedged itself for this transaction. It is very much fixed that it is going to buy the dollar at 48 and sell it at 50. So there is no risk of exchange rate fluctuation. Do you agree? Now, the next step. What happens actually is after 2 months, importer goes to the bank and he asks for early delivery. What does that mean? He wants to purchase those dollars immediately. Still, there is 1 month left for the maturity or the due date, after which he can buy the dollar from us at 50 rupees, but he needs it immediately. He is requesting us. When he is requesting the bank has two options. Either the bank can reject his request, first of all. Second, they can accept his request. If they reject his request, then there is nothing to go ahead for us. Like, I am a teacher, you are a student, we cannot do anything. But what will happen if the bank accepts this request? See, if the bank accepts this request, they will make the payment of $1 lakh at this date. So what will happen? Just look at this. This entire transaction will be settled at an early date. This 50 rupees, an early date at that rate, the agreed rate. You might ask that, sir, how is this rate applicable now? This rate was applicable for this date, for the due date after 3 months, not after 2 months. I agree. It's okay. Bank will honor the contract at this rate. Now understand what will happen. If the bank accepts his request, bank has to sell $1 lakh immediately after 2 months. And the bank was not ready at that time. Where do you think the bank is going to buy $1 lakh from? In the original contract, bank was prepared that after 3 months, they will buy it from the other bank at 48 and sell it to this customer at 50. But where do you think we are going to buy the $1 lakh now? The bank. Because that 48 rupees of the contract is getting expired after 1 month. Now, because we were unprepared, we can say we were not prepared for this transaction for early delivery, bank is going to buy those $1 lakh at spot. So what will happen? I will just write it here. Bank will buy spot. Whatever the rate is. Let's say the rate that the bank is getting in the interbank market is 51. So what is happening now? Because of the early delivery request of the customer, the bank is buying each dollar at 51 and selling it to the customer at 50, resulting into a loss of 1 rupee on each dollar. Do you think the bank is going to bear this loss? No, it will be recovered from the customer. Yes, sir. It will be recovered from the customer. One thing. What if there is a gain? What if the rate today is 49? Then there is a profit of 1 rupees which will be paid to the customer. If the loss is recovered, the profit will also be paid to the customer. So it will be a fair game. Okay, sir. For the time being, I am removing the profit side, but you keep in mind, if there is a profit, then it will be shared with the customer. If there is a loss, it will be recovered from the customer. But this is not just the loss of 1 lakh rupees, 1 rupees on $1 lakh. This is also early cash outflow to the bank. The bank was prepared for all the cash flows at this date. So apart from the loss of 1 lakh rupees or 1 rupees on each dollar, you can clearly see that because of the customer importer, bank has to make an early cash flow. So that early period is 1 month. Bank will charge. This is a net cash outflow to the bank. Because of the loss, this is a net cash outflow to the bank. Bank paid 51 lakh in the market. Bank received 50 lakh rupees from the customer. So the net cash outflow is also 1. It is the loss which will be recovered from the customer, but the interest for that 1 month will also be recovered. If it would have been a loss of 1 rupees on the due date, then there is only loss to be recovered, no interest. But this loss is incurred by the bank 1 month before the due date, and that's why the interest will also be recovered by the bank. So one thing is for sure. interest will be recovered by the bank. Okay, now couple of more things. What do you think will happen to this cover rate? What do you think will happen to this cover rate? I will just remove this. I will write it here. Why now just imagine, the bank has a contract in with the other bank that on this date I'm going to buy the dollar from that other bank. What I'm going to do with these dollars, because I was prepared to settle these dollars with this party, but now I have settled this contract with the spot buy. So what I'm going to do with this? In this case, it is mandatory. Understand? It is mandatory according to the FEDI rules that the bank should take the swap contract. Swap contract means what? Bank should cover this contract on this date itself. Didn't understand? I will tell you. Bank should make arrangement on this date itself in such a manner that this contract gets cancelled automatically with a new contract. So whatever I have to do, whatever the bank has to do, there is 1 month left for this contract. So the bank has to take 1 month forward, 1 month forward sell, because it was a buy contract for the bank. Now I will just write it first. The original contract with the customer was forward. It was forward sell, which was completed with the spot buy. Okay. Spot buy. And this was interbank market contract, cover contract, forward buy. So practically speaking, if I talk in the layman terms, this guy was supposed to get married with this guy. True? But what happened? This guy had to marry early because of some reasons. So we found a new girl for another girl, not a new girl, another girl for him, because this girl was not ready to marry early. So this guy got married with some other girl. Now there has to be some other girl here. We have to make an arrangement. Please understand. On this date, we have to make an arrangement so that this guy can marry some other girl. So we will have to take an opposite contract. Just understand. We will take the position on this date itself. If there is a buy, we will take the sell position. And since you can see there is 1 month left for this, we will take the forward contract. This is called as the swap contract. So we have to find a new partner for this guy, because for this girl, this is a girl, this is a guy, this is a girl. So this girl was about to get married with this guy, but unfortunately something happened and this guy got married with this girl. Now we have to find a new guy for this girl. Okay. Forward sell. From this point itself, we are going to take a forward sell contract. 1 month forward sell will be enough, right? This particular transaction is called as swapping. This particular transaction is called swapping, and according to the FEDI rule, even if the bank enters into a swap contract or not, whatever the swap loss is will be recovered from the customer. Let me take the transaction. Let's say the rate at which the bank will take the cover for the cover. Basically, we are now going to cover this cover rate. Okay. So the rate at which the bank is going to sell, let's say it comes to 47. So bank will sell Bank has taken 1 month forward sell at 47. Now you can clearly see that on due date, bank will buy the dollar at 48 and sell the dollar at 47. There is another loss. Okay, let's take 46 instead. 46. So you can clearly see there is a loss of 2 rupees again to the bank because of this swapping. This is called as swapping. Because of this swapping, there is another loss. Because bank had to close this cover rate, bank entered into a swap contract, and now there is a loss to the bank of 2 rupees per dollar. Buying at 48, selling at 46. This loss will also be recovered from the customer. This is the first loss. This is the second loss. And there is one more loss. Because of the early delivery, the bank has lost, or bank is not making the actual profit that it would have made had the contract been delivered on the due date. What was the original profit of the bank? It is the difference between these two. Bank was supposed to buy at 48 and sell at 50. So the loss of 2 rupees will also be recovered again from the customer. You can see there is a total loss of 5 rupees that the customer has to pay. Now this is the end of the early delivery. I need to summarize all these things. So please understand. This 50 was about to be delivered on this date, but the customer requested us to get the delivery on an early date. Okay. Now what we did is, because we were not prepared for the early delivery, we settled those with the spot contract and we incurred a loss of 1 rupees which should be recovered from the customer. Again, on the another side, we did take the cover contract for the original one, but now we have to close this cover contract with a new swap contract, right? Opposite contract. And in that we are suffering the loss of 2 rupees which shall be again recovered from the customer. Apart from these two losses, we will recover the loss of profit that we would have made had the contract been honored on the due date itself, not the early delivery date. Right. So the total loss is coming to 2 rupees of the profit, 2 rupees of the cover contract cancellation, and 1 rupees of the spot buy transaction. Spot transaction on the early delivery. So total 5 rupees will be covered. But let me make all these calculations very easy for you in the exam. Instead of doing the 3 calculations, you just have to do 1 calculation. You just have to consider only 1 calculation. Let me first cover up this. Let's take the difference between these two. You can clearly see the bank is buying at 51 and selling at 46. The total is -5. So either you take those 3 transactions, the total of those 3 will be 5 rupees of the loss, or you take these two transactions and the total of this will also be 5 rupees. This is called as swap loss. What is swap? Sir, swapping means the 2 original contracts were swapped with the another 2 original contracts. Earlier, these 2 were partners. Now, the partners has changed. Because of some reason, both of them couldn't marry with each other. And now, this is the partner, this is the partner. So these 2 guys are new in the old contracts, and the difference between the 2 new contracts, the spot and the forward sell, will be called as the swap loss. So there are only 2 things which you need to take care of it at the end of the day. The 5 rupees of the loss should be recovered, right? 5 rupees of the loss should be recovered from the customer, and interest on this 1 rupee should be recovered, because the other 2 losses are on the due date. So there is no interest required from the customer for these 2 losses, right? But this loss is before due date, and that's why we will need to recover interest for 1 month on this. So there are only 2 things which is required. Okay, one more thing. Let me change the answer. Instead of 46, let's say, what if the company or the bank would have sold those dollars at 51? Sold those dollars at 51, the dollars that they purchased from the interbank market. In that case, there is a profit to the bank of 3 rupees. So practically speaking, -1 +3 and -2. All the losses has been set off with the profit, and you can also see there is no difference between these two. So there is zero profit or loss. Okay, sir, let's change this to 49. If we change it to 49, you can see that there is a profit of 1 rupee per dollar. Bank purchased the dollar at 48, sold it at 49, and they made a profit of 1 rupee. So ultimately speaking, 1 rupees of the loss, 1 rupees of the profit, and 2 rupees of the loss. The total loss is 2 rupees only, which is again the difference between these two, 51 and 49. So even if you take the difference between, whenever you are going to take the difference between these two new contracts, it would mean you are covering 3 different losses and profit. 3, not just 1, but 3. Bank is covering the original profit that they could have earned. Bank is covering the profit or loss due to early delivery, and the bank is also covering the profit or loss due to cancellation of the interbank cover contract. Do you agree? Again, I am repeating. The difference between these two makes sure that bank is covering all the possible profits and losses. First of all, what are those 3 profits and losses? The profit and loss on the original contract that the bank could have earned, the profit and loss on the early delivery settlement, and the profit or loss on the cancellation of the interbank cover rate. So that this -2 makes sure that you are covering all the profits and losses. Apart from that -2, the only thing that you need to cover from the or recover from the customer is the interest on this. Do you understand this? Now we are going to solve some questions and you will see more of this. Let's have a look. Okay, let's read first couple of things that I have marked. Have a look. In some circumstances, customer may come to the bank before due date for delivering of foreign currency. It may buy or sell. In such situation, bank may accept or reject customers. Do you agree with this? Okay, sir. Normally, bank will accept the request. Okay. Once accepted, bank will buy or sell foreign currency at previously agreed rate. Do you agree with this? 50 rupees on early date. However, bank was not prepared for the delivery on early date, hence it will honor the contract with the spot buy or spot sell transaction. This may result into some profit or loss. Profit or loss at early delivery date will be shared with the customer. It means if there is a profit, we will give it to the customer. If there is a loss, we will recover it from the customer. Also, early delivery results into early cash outflow or inflow, and thus bank will recover interest on such cash flow and outflow or pay interest on such cash inflow. So they will recover the interest on cash outflow and pay interest on cash inflow. Okay, sir. For the remaining period of the contract. Also, bank will enter into new forward contract. Understand this. For the remaining period to cancel the cover contract. Do you agree? And the profit or loss in such transaction will be shared with the customer. For sure. In total, bank will recover or pay the following. See, profit or loss on original contract, 50 minus 48. Profit or loss on early delivery, 51 minus 50. And profit or loss on cancellation of the cover contract, 46 and 48. Total profit or loss came to 5, which can be which can be said that it is a swap loss or profit. Now, apart from this swap loss or profit, we will be charging interest as well. Swap loss or profit is calculated as the difference between the two new contracts entered into to cancel the two old contracts. According to FEDI guidelines, please understand this. Swap loss or profit will be recovered or paid to the customer irrespective of the fact whether the bank has entered into swap transaction or not. So even if the question does not ask that we have taken the swap or not, still we will be recovering that profit or loss. Okay, sir, let's go ahead for the questions. It's going to be fun. There are 6 questions on this. One of the most important part. Question number 99. On January 1, 2019, have a look. On January 1, 2019, Global Limited, an exporter. This is not an importer. This is an exporter. So it will the all the transactions that we just discussed in the previous example will be exactly opposite, because in the example that we discussed the concept, it was an importer. Now it is an exporter. So what would be the original contract by the bank? Forward buy, and the cover contract will be forward sell. So this is in the cover market, means interbank market, and this is with the customer. Both of them are expected to settle with each other, but this buy contract will come early now. Have a look. To sell $2 lakh on 31st March 2019. It was 1st January. On 31st March 2019 means 3 months from now. Okay, sir. So yeah, this is a good place. 1, 2, 3. So originally we agreed to buy dollars at 71.50, and however, due to the request of the importer, Global Limited received the amount on 20th February 2019. See, 20th February means on this date. Global Limited requested the bank to take the delivery of the remittance, early delivery, on 2nd March itself, hardly a gap of 2 days or 1 day. The interbanking rates, without adjusting the margin, whenever you will apply the rate to the customer, the merchant rate has to be considered, and whenever you take the rate for interbank transaction, no margin has to be adjusted. Spot rate of 71.2025 and 1 month premium is 5 and 10. That means it is 71.25 and 71.35. If bank agrees to take early delivery, then what will be the net inflow to Global Limited, assuming that the prevailing prime lending rate is 15%. Prevailing prime lending rate is 15%, assume 365 days in a year. Now, this is 71.50. There is no information for the cover contract in the question, and I will tell you there is no requirement also. It is not necessary that the data should be given for the cover contract, because at the end of the day we will calculate, we will calculate this figure which will cover this loss and this loss as well. So if there is no value of 48 is given in the question, still it's okay. We don't need it. We need these two values, and this is already given. Now, now, what did he do? He requested the bank to make the early delivery. That means bank will sell 1 lakh, $2 lakh to him. Bank will buy $2 lakh from him 1 month before the due date. Now what will happen? There are two things. Bank has bought, this is a buy transaction for bank. Na? What the bank is going to do with $2 lakh 1 month before the due date? They will sell it in the market at spot rate. So in the interbank market, this bank will sell it to some other market, other bank. This bank will sell those $2 lakh received early to some other bank. So other bank will buy it at spot, bid rate is applicable. Whenever the transaction is happening between two banks, the rate has to be interpreted from the other bank's angle, not us. Whenever we are entering into a transaction with the customer, then the rate has to be interpreted from our angle. So at that time, buy means bid. But when we are dealing with the other bank and we are buying, he is selling, ask rate. We are selling, he is buying, bid rate. This is how we are going to interpret. So we bought early $2 lakh and we sold it at the spot. Which rate will be applicable? 71.20. So how much amount we received? 71.20. What is the loss in this case? 30 paisa per dollar is the loss in this case, which will be recovered. Okay, sir. At the same time, we covered the cover contract. We swapped the cover contract with opposite contract. So 1 month is still left, and the cover contract, let's assume the cover contract would have been this forward sell. So what are we going to do? Forward buy. 1 month forward buy is required to cancel this cover contract. And if we want to buy, with which bank we are, with which party we are going to do this swap transaction? Interbank market. Interbank. So we are going to buy, the other bank will sell after 1 month. This is the rate applicable, ask rate. This is very important. See, I'm just repeating the transactions. Let's say, for example, the forward sell contract in the cover market, we can say, is X, and at that price we would have sold the dollars at that price, and we would have received that rupees. But now we have to close this transaction, and in order to close it, we need to buy dollars. If we buy the dollars, we will make the payment 1 month from now. 1 month from now, because we are standing at the early date now, right now 28th of the February or 2nd of the March. So 1 month from now we should buy it. If we buy it, from where we are going to buy it? With the customer? No, sir, from the interbank market. So if we buy it, the other bank will sell it, ask rate will be applicable, 71.35. So 71.35. Now understand. If you take the difference between these two, it means that you are recovering the profit that you could have earned. You are recovering this 30 paisa also, and you are recovering the profit or loss between cancellation of the cover contract also. Do you agree? We just discussed that. Okay, so let's take that 71.35. This is a loss of 0.15. So only two things are required now in the calculation. Recover this, which will mean you have recovered all the possible loss, and take the interest on this. Interest on 30 paisa and the loss of 15 paisa. 15 paisa on $2 lakh will be like around somewhere around 30,000 rupees, and the interest on 2 into 30 lakh, that is 60,000. Let's have a calculation now. So this is a swap loss of, see, 15, $2 lakh into 15, that's 30,000. And see the rates, 71.20, 71.35. These are the rates itself, 71.20 and 35. The two new contracts that you have entered to cancel the two old contract. Okay, 15 paisa is the swap loss. So you will recover this, and interest on 30 paisa. Outlay of funds, interest. This is the rate at which you bought from the customer and you sold in the market. So there is a loss to the bank in this case, but this is included in that 15 paisa. Plus, be assured about it, this loss of 30 paisa is included in this 15. So we are not going to recover that, but we will recover the interest on this 60,000 rupees. 60,000 rupees for 31 days, because 1 month is only left, at 15% per annum. So we can calculate like this: 60,000 into 15% into 31 divided by 365. So 764 is the total loss. Now what is the question asking us? What will be the net inflow to Global Limited? Obviously, sir, Global Limited is selling. He is an exporter. He will sell the dollars at 71.50. So we are going to pay him 71.50, but we will recover this loss of 30,000 and the interest of 764. Have a look. 30,764. So at 71.50, he will sell us the dollar. We will buy the dollar, and this is the payable amount to him. But because of the early delivery, we are going to deduct the losses and the interest out of the payables to him, and the net payable or net payable by us, by the bank, or inflow to the Global Limited is 142.69,236. Do you understand that? Swap loss and interest, that's it. Let's come to this question now. This, you can take this as homework. Again, this is an exporter. See, 65.40 is the price, 18% instead of 15%. Again, the 1 month premium is given. Everything is same, and this is early delivery. I will take another question which has some, in this case the swap loss is 20 and the interest is 275, which you will adjust with the total inflow to him, which becomes 65.40, and that's it. Let's come to this question. This seems a little different question. Question number 101. Dekho. On 19th January, Bank A entered into a forward contract with a customer for a forward sell of US $7,000. So, bank will sell, na? Who is going to buy? The party. Why? He might be the importer. Okay, so bank has a forward sell contract for delivery on 20th March from January to February, February to March. So after 2 months. So we can say that the original contract for the bank is 2-month forward sale. Okay. And that to 46.67. So bank will receive 46.67. On the same day, it covered its position. Obviously, bank will receive bank will pay $7,000 and receive rupees. Bank will sell this dollar, na? But in order to sell this dollar, bank has to buy the dollars on that date. They cannot buy it early. So bank covered itself in the forward interbank market at a rate of 46.655. So it was like 2-month forward buy contract. This contract bank made with the customer, and this contract the bank made with the another bank. Bank to bank transactions. Bank said that I am going to purchase every dollar at 46.655 and I will sell it at 46.67, resulting into a profit of around 0.015. Yes, the profit is 0.015 on $7,000. That's 105 rupees. So less. I don't know why. It's $7,000 or 7 lakh. I think. Okay, $7,000 itself. Cool. So the profit the bank was supposed to earn is 105 rupees on the transaction. Now, on 19th February, that means just 1 month after this transaction. So all in all, he is coming early. The original transaction was of the 2 months. Now he came early to the bank and he said, deliver. On 19th February, the customer approaches the bank and requests for early delivery at US dollar. Rates prevailing in the interbank market on that date, February, spot rate, and for the March, that is 1 month forward from February to March. Interest on outflow of the fund is 16 and inflow is 12%. Flat charges of cancellation or delivery is 100 rupees. Okay, sir. What is the amount that would be recovered from the customer on the transaction? And calculation should be made on the months basis than on the days basis. Okay, that will make our calculation easy. Now you tell us. 46.67 was to happen at this particular time, but the customer came early and we have to settle that at an early date. So just understand. Space constraints. Let me just write it here. So we sold the customer $7,000 at 46.67 at an early date. So we received this much rupees. By selling the dollar, we received rupees. And you think once again, how come we are going to sell him the dollars at an early date? We will have to buy those dollars at spot. We were not prepared for the early delivery or early sale. This was a sale, forward sell. That will be covered with a spot buy. We will buy it from the spot market from another bank. This bank will go to some another bank and then call them that this guy has come early. I have to make the payment of $7,000 to me. Just give me the rate. So the another bank will give them spot rate. I want to buy. Understand? Whenever I'm going to deal with the another bank, the rates has to be interpreted from their angle. I want to buy, the other bank will sell me. Spot selling rate is 46.58. So at this rate I am going to buy 46.58, and you can see we are making a profit. 46.67 minus 46.58. So there is a profit of 0.09, which is a good thing. Okay. That's a cash inflow. That's why the question is saying that if there is a cash inflow, the interest of 12% will only be paid to the customer. Obviously, there is a cash inflow. You can clearly see because of the early delivery, bank is making a profit, and that too early profit. So we will pay interest. The bank will pay interest. Okay. For 1 month on this 0.09 rupees per dollar. Okay. Now, but think about the cover contract. The original contract was supposed to get cancelled with this, but now this has left alone. We need to do something for this person. We need to cancel it by 1 month, because 1 month is left for the maturity. Forward sale contract, because the original one is buy. 46.655. 46.655. This is the rate at which we will buy the dollars in interbank market on due date. After buying the dollars at this rate, we were supposed to sell it in this market or at this rate to the customer. But now after buying at this rate, we will have to sell it at the forward rate that we have already taken on this date. So which type of rate is required? 1 month forward sale to cancel that. So we want to sell it to the other bank. The other bank will buy it. 1 month forward buying rate for the other bank. That will become selling rate for us. 46.3550. 46.3550. And you can clearly see that we are incurring loss in this case. We are buying at a higher rate and selling at a lower rate. 46.655 minus 46.3550. So the loss is 0.30. This will be recovered from the customer. And there is another loss of 0.09 between this. How much? 0.015. So a loss of 0.015, a loss of 0.30, and a profit of 0.09 will, what is the total of this? 0.30, 0.015 minus 0.09. So the total is 0.225. This is the total loss to be recovered from the customer, and we can calculate that with a difference between the two new contract, 46.58 and 46.3550. The difference between these two new contract covers all the profits and losses, which is 0.225 at $7,000. The loss is 1575 to be recovered, and we need to make an interest payment on this. 0.09 into $7,000, $7,000 into 12% for 1 month. Very small amount. See, 0.09 on $7,000 at 12% for 1 month comes to 6 rupees 30 paisa. For 12 month it comes to 630, I think, or whatever. Acha, interest on 630. So it is like this: 7,000 into 0.09 into 12% into 1 by 12. All of that is 6 rupees 30 paisa payable to the customer. Now understand, swap loss is 1575, flat charges is 100, and less interest, because we have to make this payment to the customer, 6.30. So this is the total loss to be recovered from the customer apart from the delivery of the original $7,000. So amount as per forward contract, he is buying $7,000. That means we will receive this, and we will also receive the charges as a loss recovery from the customer. So both of them will be recovered. That's it. Easy. Okay, sir. You will take this as homework. I will tell you why. Exactly similar to the previous one. In this case, the party is exporter, not an importer. In the previous one, it was an importer. And you can see that deposit rate is 5% and lending rate is 10%. What does that mean? That means if you have to charge, or this is a cash outflow rate and this is a cash inflow rate. So if there is an inflow in the previous date, you will pay him only 5%, but at the time of recovery, you will recover 10%. And swap points are in descending order, you are going to deduct it. So it will be around 70.07 and 70.17. 15 and 10 points. Okay. What else? There are two rates at the beginning. Exporter will sell to us. That means we have a buy contract with the customer and sell contract in the forward market, cover market, right? Let's do the transaction. I will just show you a couple of things. In fact, what are the rates? 70. See, I will just show you here. Early date, and that too 1 month itself. So this is the rate 70.40, which we had to pay to the customer because he sold the dollars to us. We had a forward buy contract that was supposed to be paid on this date, but early delivery had to happen, and we sold the we bought the dollars from him at this rate. What are we going to do with those dollars? We will have to sell it spot. When we will sell spot in the interbank market, the other bank will buy, and hence bid rate is required for spot. All the dollars. How many dollars, sir? $1 lakh. So we will receive $1 lakh. Do you agree? The other party wants to sell it. We will receive it and we will sell all the dollars at spot. What are we going to do with the dollars early received? So what is the bid rate at spot? 70.22. And that's a selling rate to us. 70.22. Now you can clearly see that we have an outflow of 18 paisa. 22 is the receipt and 40 is the outflow. So loss of 0.18, we are going to charge interest at 10% for 1 month. I think, let me just clear. Yeah, it on 28th November early delivery is happening, and on 31st December was the due date. Okay, the cover deal was 70.60. Cover means exactly opposite of the customer. Customer was about to sell the dollar. We had a forward buy with the customer. That means forward sell in the cover deal. So we expected that we will sell these dollars received from the customer in the interbank market at 70.60 on due date. But now, since these dollars has been received early and sold in the spot market, what do you think, from where we are going to bring the dollars to sell it in the cover deal? Because the cover deal is of sell dollars. How are we going to sell the dollars at this rate? We will have to buy the dollars, and that arrangement has been made by us on this date itself. 1 month forward buy. 1 month forward buy, because the original contract was like this. This was 3 month forward sell. This was 3 month forward buy. It was 3 month or 2 month, October, November, December, 2 months. Both of them were 2 months. So original contracts were this: 2 month forward buy, 2 month forward sell. But this buy contract got cancelled with the spot sell, and now this 2 month forward sell will get cancelled with the 1 month forward buy. So opposite contract will only get cancelled with each other. 1 month forward buy in the interbank market. We want to buy, the other bank will sell. That means ask rate 70.17, right? So we will buy it at 70.17. Am I right? And there is a profit in this case of 43 paisa. So we will have a profit in this case, loss in this case, and the original profit that we would have earned was of 20 paisa. So this is a loss now to us because the contract didn't happen as the transaction didn't happen as contracted or as agreed. So that 20 paisa loss of the profit, 18 rupees loss of the early settlement, and 43 paisa profit of the cover deal cancellation will be shared with all of them three will be totaled and shared with the customer. What is the total of them? 0.18 plus 0.20 and minus 0.43. Ultimately 5 paisa is what is the profit. See, if you do the total of these two, you can see that you are receiving more than paying. So there is a profit of 0.05 paisa. This will be paid to the customer. There is a profit. Why to recover? Pay to the customer on 1 lakh 5,000 rupees. You will pay 5,000 rupees to the customer, but swap loss or swap profit you can say on this case 1 lakh into 0.05 5,000, but you will recover the interest 1 lakh into 0.18 into 10% into 1 by 12. Am I right? Consider 365 days. Okay, so from 28th November, I think they should take 1 month itself, not 32, 33 days. Let's find out. Yeah, 31 days. 31 days. Cool. I was like, they will consider 29 and 30 as well, like 33 days. So 1 lakh into 0.18 into 10% divided by 2. So that 150 rupees of the interest will be deducted out of the profit to be given to them. 4850 is payable to them. Have a look. 5,000 swap gain 5,000. Interest on outlay 153. So 5,000 minus 153, 4847 to be adjusted with the original amount of sale. He sold $1 lakh to us at this rate. So we have to pay 70.40, and before after adjusting 4847 we will pay only this much. Just a second. Oh, he will have to, we are paying 4847 to him itself. So this is also a cash outflow to us. This is also a cash outflow to us. Gain is shared with the bank, by the bank. Okay, so in this question we shared the gain with the customer. Interesting one. Let's have a look on this question now. Let me see if this is something new or not. Okay, so this is quite interesting question. This question is very much similar to the previous question except for the addition of this. Let me just cover up the second part only, but before that I will discuss the question. Have a look. I think by now you are very much comfortable at the early delivery part. Just the 4 values, and the difference between the two will be the swap loss and gain and interest part. That's it. Okay, so on 1st of October, Mr. Guru is an exporter. That means he wants to sell the currency to bank. We are the bank. He will be selling foreign currency. So the bank has a forward buy contract because bank will be buying. So for bank it's a forward buy contract, okay, at 75.40, and from 1st October to 31st December, that means 3 months. Okay, however, at the request of the importer, importer means exporter sold the goods to the customer and he is the importer, na? So at his request, he received the amount early. Mr. Guru received the amount on 30th November itself. That means a month before the due date. Again, same, the gap is 1 month. Mr. Guru requested the bank to take the delivery. Mr. Guru said that instead of buying at the end of 3 months, buy it at the end of 2 months itself. I will sell it to you. He said that to bank. Okay. Before due date. Okay. The interbank rate is on the 30th November, on the date of the request, was like spot INR USD 75.22. Do not interpret it as a ISO rate. It's 75.22 rupees per dollar. I can clearly say that. So there is a problem in framing the rates. This is not proper. It should be USD INR. Okay. 1 month premium is in ascending order, so we can calculate it 75.32 plus and 75.42. Okay, sir. 32 and 32 and 42. Assume 365 days in a year. This first part is exactly similar to the previous question, that if the bank agrees for the early delivery, then what will be the inflow to Mr. Guru? He will sell the dollar to us. How much we are going to pay to the Guru at a prime lending rate of 18% per annum. So let me just cover up fast. 1, 2 and 3. From the bank's angle, bank was about to buy the foreign currency at an agreed rate of 75.40. If the bank will buy, they will make the payment of 75.40 for every dollar. And by buying at this rate, let's say for example, bank has taken the cover deal for selling those dollars at this rate, whatever it is, doesn't matter. But because of the request of the exporter, we had to take the early delivery. Means we had to buy those dollars at 1 month before, like date. Okay. So now these two contracts cannot be adjusted with each other. That means bank has lost the profit that they could have earned. No, it doesn't matter. We will recover that. Since bank has bought the dollars before due date, that means at an early date, what the bank will do? Bank will sell those dollars at spot. Bank will sell it. The other bank will buy it. Bid rate will be applicable 75.22. So we will sell it at 75.22 and we will receive this much. You can clearly see there is a loss to the bank. They bought it at 75.40 and sold it at 75.22. There is a loss of 18 paisa on every dollar. We will make sure that we recover. Also, after doing that, on this date itself, we need to make sure that we are covering this sell forward contract. We were about to sell the dollars that we would have received from the customer at this rate. But how are we going to sell now? We will have to buy it 1 month buy. So we will have to enter into 1 month forward buy from the interbank market. That means interbank, the other bank will sell it. Ask rate will be applicable. What is the rate applicable? Ask rate 75.42. We are going to buy it at 75.42. So whatever is the profit or loss, this is also going to be recovered. Whatever is the profit from this will also be recovered. And all these can be recovered by taking the difference between these two. You know that very clearly. So you can clearly see that there is a swap loss of 20 paisa in between these two. So there are two things that will be recovered. And what is the amount? $1 lakh. So it will be very easy. $1 lakh into 0.20 becomes 20,000 rupees of the swap loss, and 18,000 multiplied by interest on 18,000 will be at 18% into 18% into 31 by 365. That's it. See, 20,000, 18,000 into 31 by 365 into 18%. So this is the interest. We will add both of them. This is what we are going to recover from the customer. And what is the amount to be payable to him for selling the dollars at an early date? 1 lakh into 75.40 agreed rate. This is the amount to be paid to him less the recovery total amount to be paid to him. 75 lakh 19,000. That's okay, sir. But tell me one thing. He received the dollars at early date. Guru received the dollars at early date. Instead of going to the bank and asking for the early delivery to the bank, he could have invested this dollar somewhere else for 1 month. And he could have earned, understand, on 1 lakh dollar, he could have earned 3% for 1 month. So what would have been the interest? 1 lakh into 3% into 31 divided by 365 comes to 254. Once again, 1 lakh into 3% into 31 divided by 365 comes to 254.79. Now after, what will happen? This will be received by him on this date. For 1 month he invested that early receipt of 1 lakh dollar. So on due date he is going to receive now 1 lakh 254.79 dollar, right? Out of this he made an agreement with the bank already to sell 1 lakh dollar at an agreed rate of 75.40. He cannot sell the entire amount in the forward because he had taken the forward only for this much of the dollars. So this much of the dollars can only be sold at this rate. Now tell me, the balance $254.79 will be sold in the spot market. Sell it in the spot market. So customer will sell it, this bank will buy it, the other bank will buy it. So buying rate will be applicable of the buying rate is not there in this case. But I will tell you, he invested all the amount 1 month before itself. He knew that 254.79 is going to be the extra amount that he is going to receive. So he took 1 month forward sell. For him it's a sell contract, for bank it's a buy contract, 1 month forward buy. That means this is the rate at which he is going to bid rate. Bank will buy those dollars, extra dollars, interest at 75.32. No margin is given. Practically there should have been the margin because these are the interest interbank rate. But forget it. 75.32 will be the rate. 75.32. So 75,40,000 will be received by him under the normal original contract, and 254.79 into 75.32. 19,191 plus, let's do the total, 75,40,000 plus 19,191. So the total that he would have received is 75,59,191 if he would have invested those early delivered dollars somewhere else rather than going to bank and requesting the early delivery. 75,59,191. Original amount and the interest. See, he sold the extra dollars that he has received in the spot market. Spot means the forward rate. And he took this forward rate 1 month before itself at the time of investment of 1 lakh dollar. He knew that he is going to earn some extra interest, and those interest amount has to be sold in the market. He took the forward buy or forward sell contract. That's it. Easy one. With this, I think we finish all the questions related to early delivery. Let me just check once again. Yeah, 103rd question, forward contract early delivery before due date. So till this question, early delivery concept was there, and I think we have taken lots of questions. Almost all the questions has been discussed by us. Now from 104th, from 104th to 107, 4, 5, 6, 7, 4 questions on late delivery, late extension, late cancellation. All the 3 concepts will be discussed by me after this break. See you. So welcome back everyone, and now we are going to discuss about this late delivery, late cancellation and late extension contract. See, what happens when the customer does not appear on the due date? The bank will always treat him as a defaulter. Now, in case of late means on due date the customer is not appearing, he is appearing after the due date. That means all the original contract will have to be cancelled now. Everything has to be cancelled. See, late delivery, late cancellation or late extension, everything will be discussed by us. Bank will treat the customer as defaulter in all the cases of late transaction. This means that only losses will be recovered but gains, if any, will not be shared. So this time we are not going to pay them gains. Like in case of early delivery, we shared the gain with customer. We recovered the loss but shared the gain as well. But in case of late extension, cancellation or delivery, we will treat the customer as, bank will treat the customer as defaulter, and only losses, if there is any, will be recovered. If there is a gain, it will not be shared with the customer. See, so if there is a cancellation loss, recover it. Cancellation gain, do not pay to the customer. Swap loss, recover it. Swap gain, do not give it to the customer. Interest on outlay, recover it. But interest on inflow, do not give it to the customer. So no benefits are given to the customer for defaulting the transaction. Okay. In all the cases of late transaction, original contract will be cancelled. Original contract will get cancelled. Now understand what happens. Let's say this is the due date. Okay. What would have happened? The bank has two contracts on this date. One with the customer and one in the cover deal. Just to cover up the customer in the cover deal. On this date, if you do not appear to the bank as a customer, the bank will close the cover deal. Bank will have to honor the cover deal. So if the bank has a forward buy contract in cover market, they will just enter into spot sell. See, on this date, this is a customer contract and this is a cover contract. If the bank has forward buy, they will cancel it with spot sell, because by buying the dollars, what the bank is going to do, the customer has not appeared today, otherwise we would have bought it in the cover market, interbank market, and then sold it to the customer. But if the customer is not appearing, we will have to sell it at spot. Okay. But if the bank has forward sell contract, bank will take spot buy contract. So in both the cases, on due date, now the cover contract will get cancelled with the spot contract. Opposite, buy sell, sell buy. So on this date, cover deal will get cancelled with the spot rates. Cool. Now after this date, the FEDI rule says that there are 3 days of opportunity that can be given to the customer. 3 days are the maximum limit. After the due date, the customer can appear to the bank, and on that date he can honor the contract. Let's say, for example, he appears on the second day after the due date and he says that I want to deliver. So basically the original contract with the customer was of sale. We were about to sell the dollars to him. Now after 2 days he is asking the dollar from us. What are we going to do? Sir, this customer contract will get cancelled on the spot rate. He will have to, just understand, he will have to buy, if he wants the delivery today, he will have to buy it at the spot rate. Simply buy it at the spot rate now. The old rate is not applicable. If you want to cancel it, automatically we will cancel it. Once you cross the due date, whether you want to deliver, cancel or extend, in all the cases the original contract will get cancelled automatically. It will get cancelled on the date that you appear. So if you appear on the second day after the due date, on that day's rate, your contract will get cancelled. So you had a forward sell contract. The bank had a forward sell contract. Bank will take spot buy. Bank will spot buy on that date to cancel your contract. Okay. So there are only 3 days given to the customer that the customer can come and cancel the original contract and then enter into a new contract if they want to. But if the customer does not appear in 3 days, what will happen? Let's say, for example, if he appears on the 5th day, then on the third day itself, the bank will automatically cancel his contract without communicating with the customer. So there are only 3 days limit. So the third day's rate will be final for all the future days. See, if the customer is coming to the first day after the due date, first day's rate will be applicable, second day's rate will be applicable, third day's rate will be applicable, and from this point onward only third day's rate. That means the contract now is automatically cancelled. You can come at any time. This is called as automatic cancellation. These cancellation charges will be recovered from customer, gain if any will not be shared. Have a look. In all the cases of late transaction, original contract will get cancelled at the spot rate when the customer appeared, or at the spot rate of the third day after due date, whichever is earlier. So if you are appearing on the first and the second day, then that day's rate will be applicable, and from third day onwards only third day's rate will be applicable to cancel. This is called as automatic cancellation. Only 3 days grace period is given to you if you want to close the contract. But after that, automatically it will get cancelled on the third day's rate. Okay, sir. Now, apart from the cancellation charges, bank will also recover swap loss and interest on outlay of fund. Now, this much of the amount though already recovered in the early delivery also. But in this late extension, we will recover cancellation charges. This is the third item that will be recovered in the late part. In the early delivery, there were only 2 items that we used to recover from the customer. But in the late part, the cancellation charges will also be recovered. And this cancellation charges will be the difference between the rate agreed between the bank and the customer and either 1 to 3 days rate, either of the 3. Okay, sir. On due date, bank will cancel the cover contract. I was talking about this. On the due date, if the customer does not appear, what the bank is going to do with the cover contract? They will cancel the cover contract by entering into spot transaction. So if the cover contract is buy, spot sell. Cover contract is sell, spot buy. This will result into cash inflow or outflow. Bank will recover interest on outflow from the due date till the date of the settlement by the customer. So all the interest will be recovered from that day onwards. Bank will also take cover for the closest forward contract. Now what will happen, I will tell you. This is the due date. Okay. On this date, the customer did not appear. So this is the cover rate. Now understand from this point, I will just explain. Let's say the original contract was to sell the dollars to the bank at 50, sell the dollars to the customer at 50 rupees on due date. But, one more thing. Sell the dollars to the customer at 50 rupees and buy it in the cover market at 48. So all these 2 transactions, 50 and 48, was supposed to happen on due date. Bank was supposed to buy 48 rupees per dollar and sell dollar at 50 rupees on due date. But what happened on due date? Customer did not appear. And the bank had this purchase. Bank had to purchase the dollar. But this was supposed to be settled with the customer and the customer did not appear. Bank sold those dollar in the spot market. You can see this is a spot sell. And in that transaction, bank had to bear the loss of 1 rupee because they purchased at 48. They purchased the dollar at 48 and sold it at 47. There is a loss of 1 rupee that will be recovered. So this is the cancellation of cover contract. Okay, sir. Now, this is the first loss when you cancel the cover contract. Second, on this date itself, bank will enter into a new swap forward buy contract. Why? This is just a swapping. In reality, even if the bank is not swapping, still the swap loss will be recovered assuming the rate assuming the bank has swapped. This is what the FedI says. FedI says that it is not necessary for the bank to enter into a swap contract, but swap loss will be recovered, assuming the bank has entered into. So that's the charges for the default, you can say. So if the customer comes after some days, let's say for example, a couple of days. So at that time we will have to sell the dollars to the customer, and at that time we will need the dollars. That's why we are making a provision that the closest forward contract, we will take the closest forward contract as a swap contract. So 1 month forward buy has been taken, the closest by the bank. If 15 days forward contract is available, take the 15 days. Closest is the answer. And this would mean that we will buy. This is just a calculation. In reality, this will not happen. This would mean that the bank will buy the dollars at 52 rupees when the customer will appear and sell it to the customer at 50 rupees, whatever the rate was. And in that process, if the bank is suffering some losses or bearing some losses, this will be called as the loss due to swap transaction. It's not a swap loss altogether, but due to that transaction. So this will also be recovered. We will recover the cover deal which has been cancelled at spot. We will recover this one also. We will recover the probable profit that we would have earned had there been no default from the customer. So all the three will be recovered. This 2 rupees, 2 rupees and 1 rupees. And you know how to calculate this 2 to 1 rupees? It is nothing but the difference between these two rates. The forward rate, the swap contract that the bank had entered into, and the spot contract on due date. The difference between these two will be 5 rupees. But this is just a swap loss. 5 rupees is just a swap loss. Understand? This is just one thing that the bank is recovering. Second thing is the interest on this outflow. And there will be third thing, just understand, there will be third thing which will be called as cancellation of the forward contract with the customer. So we had a forward sell contract with the customer at rupees 50. Okay. Now we have given first day, second day, third day. Otherwise third day will be automatic cancellation. So out of these 3 days, whichever rate is applicable, that rate will be used to cancel the contract with the customer, and this will be recovered from the customer. So this is something new. The third item, cancellation charges. Cancellation charges will be recovered from the customer. In any case, if there is any profit, it will not be shared with the customer. Please understand that. No inflow, interest on inflow, no profit of swap, no swap profit, no cancellation profit. If there is a loss, that will be recovered. Profit will not be shared with him. So now are you getting it? What is happening? This is the new part in this late concept. Otherwise, all the other things are exactly like what we did in the early delivery part. So cancellation charges. Now have a look. In case of early delivery, we had two types of recoveries, swap loss and interest. And again, in case of early delivery, we used to share swap gain and inflow, interest on inflow. But in case of late delivery extension and cancellation, we will recover the swap loss, not share the swap gain. We will not share the swap gain. We will recover the interest on outflow, will not pay interest on inflow, and we will recover the cancellation charges. Let me talk to you about the cancellation charges. Cancellation charges is the rate at which the original contract will be cancelled, and it can be the first day after the due date, second day's rate, or the third day's rate. In between these 3 days, if the customer is appearing early, he will get that rate. Otherwise, third day's rate will be applicable. Okay, sir. With this, we are going to solve some question, and then we will see that how interesting is this. Have a look. Question number 104. 104. 5 will be your homework. It's similar to 104. Let me see. 6 will be done by us in the class because it has 3 different things. 7 can be taken. I think we can take 7 instead of 4. There are 3 dates in that. and yeah, so 3 questions will be taken by us: 6, 7 and 4. Fifth one is the only homework, I think. Yeah. So out of 4, we are going to solve 3 questions. This is the easiest one. Have a look. See, Y has to remit 1 lakh US dollar for his son's education on 4th April 2018. And basically, he acts as an importer because he wants to buy dollars. Why? So, for a customer, it is forward buy, and for a bank, we will speak from the angle of the bank. For the bank, it is forward sell, original contract. What would have been the cover contract for the bank? Forward buy. So these are the 2 rates. Okay. Bank will sell $1 lakh to Y. He has booked a forward contract with his bank on 4th January, that is 63 rupees 8775. So bank agreed to sell him $1 lakh at this price. But obviously, where do you think the bank is going to get $1 lakh? They will buy it from the interbank market, and that's why they have covered themselves already. They don't want to take the risk of buying at a higher rate and then selling it to the customer at the agreed rate. Okay. So they have already taken the forward contract for buying it. This is the cover rate, 63.7575. So they made sure that if the transaction happens as agreed, they will make a profit of 0.12 rupees per dollar. So practically 12,000 rupees is what they are eyeing upon, the profit. The exchange rate for US dollar in the interbank market on 4th and 6th April is given to you. Okay. 4th April and 6th April, this is the spot rate. Now understand, after the spot rates, again the spot of April is given. Now a lot of people will get confused, but please understand, this is the 4th April, and on 4th April, the forward rate for the April closing, you can say May closing, June closing, July closings are given, or any date in April. But if April is written, that means you can say it will be like 24th April, 26th April, any date but 4th April. So this is the closest forward contract which is available for the same month. Okay, sir. And on 6th April, the forward rates has changed for all this April, May, June, July. Every day's forward rate for the future months will be different, right? So on 4th April, these are the forward rates for each month. And on 6th April, these are the forward rates for each month. Okay. Exchange margin of 0.10% and interest on outlay of 12% per annum will be applicable. The remitter, due to rescheduling of semester of his son, has requested on 6th April. When he went to request on 6th April, that means he has defaulted. He should have presented himself on 4th April at least to cancel the contract. That will be treated as cancellation on due date. But he did not come on the 4th April and he appeared only on 6th April for extension of the contract with due date of 6th June. So on 6th April, he said, I need a new contract of 6th June. So these rates will be applicable. First of all, because he requested on 6th April, so these columns rate are important for June. So these rates for new contract. That's okay, but let's talk about the original contract first. Acha, one more thing. He wants a new contract now. He want to buy the dollars. Am I right? He will buy the dollars now in June. He will buy it, bank will sell it. So, and the dollar is the base currency. This rate will be applicable, 63.7275, but this is a ask rate. Bank will add 0.10% margin in that, and after that it will be applicable to the customer. That means Why? But this is the new rate for new contract. Let's settle the original contract. Rate must be rounded off to 4 decimal in multiples of 0.0025. First of all, cancellation rate. I told you there are 3 days after the due date. So 5th, 6th and 7th. There were only 3 days, but fortunately he appeared on 6th April. Okay. Now, in order to cancel the contract with the customer, understand that bank had a forward sell contract with the customer. In order to cancel that, bank will take spot, because now today is 6th April, buy contract. Am I right? And bank is entering into a spot buy contract. Bank is buying, bid rate will be applicable. So this rate is applicable. Am I right? 63.1575 for the cancellation. 6th April's rate, second day. Bank will buy it, because earlier it was forward sell. In order to cancel that, we will take spot buy in order to cancel the sell position. And if the bank will buy from the customer, you need to make sure that from who is the other party. If the other party is customer, these rates are your rates. If the other party is the second bank, these rates are their other bank's rate. That is what the magic is. Okay. So bid rate is applicable, that is 63.1575. After that, you are going to deduct the margin from it, because these are interbank rate. So cancellation rate will be 63.1575 less margin. Why less? Because this is a bid rate. Bank will pay this 63 and receive or keep the margin. So this is cash outflow to the bank, this is cash inflow. Okay, 63.1575. Let's confirm that first. 63.1575 less margin of 0.10%. We received this rate and rounded it off to nearest 0.0025. Cool. This is the rate at which we are going to cancel. Now what will be the cancellation charges? This minus the difference, the agreed rate, 63.8775. Have a look. Minus 63.8775. Now once again, from the bank's angle, if you take it from the bank's angle, this is the rate at which bank agreed to sell dollars to him. If the bank will sell dollar, they will get rupees, 63.8775. But now they are cancelling by buying at this rate, 63.0950. Am I right? Yes. So you can see, because of the cancellation, the bank is at profit. That means the customer will be at loss because of the cancellation, that too 0.7825. Don't think that the bank has made a profit due to cancellation. No, sir. It's a profit to the bank or an inflow to the bank due to cancellation. That means it should be outflow to the customer because of cancellation. Only then there will be a profit. Na? 0.7825 into 1 lakh. Yes. So the cancellation charges is 78,250. Now there are only two things to consider, and you know them very well. You have learned them in the early delivery case: swap loss and interest on outflow fund. Very easy. You can just frame all of them here itself. See, let's say this is the due date, 4th April, and he appeared on the 6th April. Okay. So you were about to sell 63.8775. 63.8775 was the selling rate. 63.7575 was the buying rate to you on due date. Now what you did with that? You bought the dollars to sell to the customers on 4th of the April. But the customer did not appear. What did you do with these dollars? You sold it. You sold it and you received money at spot. Now you are selling the dollars. See, understand, we are talking about the cover contract. You had a buy contract, forward buy, which is expiring today itself. In order to cancel forward buy, you will go with spot sell, and that too interbank. So these rates will be treated from interbank angle. Today on 4th April, you are selling those dollars. Spot sell for you, buy for the other bank. The other bank will buy it on spot 63.2775 on 4th April. Just have a look once again. You will sell it, bank will buy it 63.2775, and you can see there is a loss of 48 paisa because you bought the dollars at a higher price and sold it in the interbank market. Whenever you have to sell or buy the currency with interbank market, take the rates from interbank market, not you. But whenever you have to buy or sell the currency with the client or the customer, take the rates from your angle. Now I have to sell it at the spot rate in the interbank market. So I will sell it, bank will buy it. Bid rate 4th April. Okay, sir. And there are no margins adjusted when the transaction is with interbank, like the other bank. So this is the loss. Okay. What will happen to this? Even if the bank is not taking the swap transaction, FedI says that we have to recover the swap loss. And this was a transaction of forward sell with the customer. What are we going to do from this to this? Closest 2 days are the only difference now. So closest forward contract will be taken to swap this. It will be forward buy, and that too with the interbank. That means the other bank will sell. Closest ask rate of 1 month is required. 1 month or the closest forward contract, and that too ask rate. And when did we take this contract? We took it on the 4th April itself. The swap contract was taken on the 4th April. What does the FedI guideline says on this date, whether you want to do it or not, but we will assume that you are doing the swap. You are swapping this contract, original contract. So it was a forward sell, go with the forward buy, closest of the forward buy, not like 1 or 2 month or 3 month. So forward buy from you, and you are doing this with, this was with customer, then it's okay. This was with the other bank itself, right? So think from the other bank's angle. You want to buy, this bank wants to buy, other bank will sell it, ask rate. Closest ask rate on 4th of the April. Do you think this is the rate applicable? On 4th of the April, closest forward rate is this first, and that to ask from the other bank's angle 63.4275. Do you think there is a need to add margin in that? No, sir. This is the transaction with other bank, interbank. 63.4275. Have a look. 63.4275, and you are buying dollars, forward buy. You can see now there is a profit in this case. That's 0.45. One thing is that, and the original contract, if it would have happened, then there would have been a profit in that as well. How much? 12 paisa. We lost this because the customer did not appear. Now this is 12 paisa. Understand, we lost this. Now this has minus 0.12. Now there are 3 things that the bank will recover. This, and this. Do the total of it now. 0.48 plus 0.12 minus 0.45. So 15 paisa is the net answer. And net is the swap loss. On 1 lakh, that means 15,000 rupees will be recovered as a swap loss. And you can calculate that as a difference between these two itself. 63.4275, 63.2775. 15 paisa. So you need not go by these 3. You just have to go it like this. The difference between the 2 new contracts. See, these are the 2 old contracts. Do you agree? The covered contract, the cover rate, and the rate with the customer. The cover rate was sold in the market at spot, and we have taken a swap for this. This is taken just to calculate the swap loss of 15,000. Have a look. Now 15,000 is a swap loss. There are three things. First one was the cancellation. How much is the cancellation charges? 78,250. Second, there is a swap loss of 15 paisa, 15,000. This will also be recovered. And interest on outflow of 48,000 rupees. 40.48 into 1 lakh. Outflow. How many days? 2 days. Because the customer appeared on 6th. 2 days of interest will be applicable on that. So, have a look. Do you agree with the swap loss of 15? These are the two new contracts. 63.4275 and 2775. 4275 and 2775. Two new contracts. Now, interest on outlay on 48,000 for 2 days. Do you agree with this? Okay, sir. Swap loss and 78,250 cancellation charges. So how much you have to pay on $1 lakh? On $1 lakh the cancellation is 78,250. So we have answered lots of questions already. Let me just check it. Cancellation rate. Amount payable on $1 lakh as a cancellation charges, which is 78,250. Swap loss 15,000 and interest on outflow. For 2 days of interest on 48,000. New contract rate is this 63.7275 plus margin. Have a look. Hmm. 63.7275, right? Ask rate. I will just repeat that again. On 6th of the April, customer says that I'm going to buy the dollars from you on June. Customer will buy it, we will sell it to the customer. We will sell it, bank will sell it, ask rate 63.7275. See? Plus margin because it is ask rate. And closest of the rate is 63.79. That's it. The total cost is the cancellation charges of 78,250, swap loss of 15,000 and interest of 32 rupees. This is the total cost that the customer will have to pay. I hope you understood this entire question. What if he would have appeared on the 8th of April? Then 4, 5, 6, 7. 7th April's rate would have been applicable for cancellation. Rest of the things are same. Okay, let's move on to the next question. The next question is your homework, question number 105. Let's take question number 106 now. This is interesting. There are three things to cover in this contract. See, on 10th July, an importer entered into a forward contract with a bank. Importer will buy foreign currency from the bank. Bank will sell foreign currency to the importer. It's a forward sell from the bank's angle. Bank will sell $50,000. Just a second. Okay. Bank will sell $50,000 to the importer at a rate of 66.84. But in order to sell those dollars, bank has covered itself in a interbank market at 66.68. What does that mean? It means that on 10th July itself, bank has entered into a contract with importer and the other bank. From the other bank on 10th of the September, from July, August, September, I think 2 months after that, our bank will buy the dollars from other bank at 66.68 and sell it to the importer at 66.84, making a profit of difference between these. Okay, so from our bank's angle, this is a forward sell, this is a forward buy. Both of them has to cancel with each other if the delivery happens as agreed. What is the profit to the bank in this? 66.84 minus 66.68. 66.84 minus 66.68. So expected profit to the bank is 0.6 multiplied by 0.16 multiplied by 50,000. That's around 8,000. But he's not going to appear. And that's why bank will lose this profit of 8,000. Bank will cover it up. Don't worry. Okay, how the bank would react if the customer requests on 12th of the September? The due date was 10th of the September. He has defaulted, and once the customer defaults, there are few things that the bank will recover no matter what the customer request. If the customer request for the delivery, execute means delivery. That means if he wants to buy the dollars on 12th September, cancel the contract on 12th September or extend the contract. In all the three cases, there are some charges which the bank will recover for sure. First charge, cancellation. Second charge, swap loss. Third charge, interest on outlay. All the three will be the cost in all these three options. Now, if apart from this cost, if he wants to cancel, there is nothing else which is required. No other action is required to be taken here. If he wants to execute, that means you want to buy $50,000, buy it at spot rate. Bank will sell it at spot rate of 12th of the September. Bank will sell it to the customer at spot rate. Bank's asking rate, sell rate. If he wants to extend the contract, that means on 12th of the September, he is asking for 10th of the November contract. That means he will come and buy the dollars on 10th of the November. But this request has been placed on 12th of the September, so this column is required. And now on November, he is going to buy, we are going to sell this rate. So in the third case, this rate will be applicable. In the second case, this rate will be applicable. Both of them are ask rate. Margin will be added to that. 0.1%, 0.1%. That's it. So this is the forward rate simply. But in this case, there will be an outflow. 65.99 plus margin into 50,000. That's another outflow apart from the cost. But these three are most important to recover. Okay, let's calculate one by one. First of all, let's take the cancellation. What is the rule for cancellation? You need to be very clear about the rule. After the due date, there are only 3 days grace period for the customer. He can come and cancel the contract on the rate of 11th September, 12th September and 13th September. If he is coming after 30th September, that means only 3 days. So if he is coming after 3 days, then 13th September rate that will be applicable. Now, the original contract with the customer is forward sell. In order to cancel it, bank will take the the spot rate on 12th. The closest one was the swap. So in order to cancel the contract on 12th of the September, bank will use spot buy rate. Why spot? Because bank will cancel on the same day customer appeared, and that is under 3 days. So spot. Second, why buy? Because we had a sell contract. So bank is, and this has been charged to the customer. Understand? So all the rates will be taken from our angle because this is applied to the customer. Okay. Spot buy on 12th September. We are buying. Spot buy on 12th September, 65.96. This will be charged as a cancellation rate to the customer. But this is a bid rate, interbank market. We will deduct margin out of that 0.10%. This will become the cancellation rate. Do you agree with this? 0.10, 65.96 minus 0.10. Rounded off to nearest 0.0025. Now 65.8950 has become the cancellation rate. Okay. With this rate we can cancel. How did we decide this? Simple. Bank had a forward sell contract with the customer and there were only 3 days available with the customer. He came on 12th of the September. So bank cancelled it. In order to cancel, we take the opposite position. So we will cancel first on spot. Another thing is, in place of sell we will buy, and we are doing it with the customer itself. So we are going to look at these rates from our angle. If the transaction is with other bank's angle. Okay, so spot buy on 12th September is 65.96. So this is the final rate applicable. Spot buy. Bank will buy at 65.8950 and sell to the customer itself at 66.84. So this is done with the customer, and you can see the bank is receiving money 0.94 from whom? The customer itself, into 50,000. So 47,250 becomes the cancellation charges in all the cases. Original contract will get cancelled no matter what you decide to do after the due date, because you have defaulted. First thing. Now let's come to the swap loss. 4 rates. Very simple. Where is the timeline? Okay, I can draw it here. 10th and 12th. Cover rate will be cancelled first. Now, your cover rate was a forward buy. You were supposed to buy the dollars at 66.68. Buy, that means outflow. And sell it to the customer, but the customer did not appear. What did you do? Forward buy. What did you do with this? You sold at spot selling rate to the other bank. To the other bank, not the customer, other bank. That means these rates have to be taken from the angle of the other bank. We want to sell spot on 10th of the September. We want to sell spot just to cover up the cover contract. Bank will buy, the other bank will buy. That means bid rate, spot bid rate 66.15, and this is what we are going to receive. See, there is a clear cut loss. 66.68 is what the at this price we bought the dollar, and 66.15 is selling rate. 0.53 is the loss to be recovered from the customer, but we will recover 2 days interest on 0.53 into 50,000. That means 26,500 rupees into 12% into 2 by 365. That will be the interest cost. Okay. Apart from that, our original contract was 66.84. We were about to sell to the customer 66.84. See, on this date itself, when the bank got to know that the customer has not appeared, the bank will cancel this contract, cover contract with the spot sell, and they will take a swap contract also to cover this rate 66.84 of the customer. So this swap contract will be entered with the other bank. Now this was a forward sell. You can see FS, forward sell. That means the bank will take a forward contract because it is 2 days or 3 days away. Bank didn't know, na? Bank didn't know on 10th of the September when the customer is going to appear. So they took the closest forward contract, and that to buy with the interbank market. So again, the other bank will sell, ask rate is applicable. Other bank will sell, na? Interbank market rates has to be taken from the other bank's angle. So on 10th of the September, closest forward buy rate for us is the ask rate of other bank. On 10th of the September, closest rate is this, which is the ask of the other bank. That is very difficult to understand. Whenever you do the transaction with interbank, that means in interbank market with other bank, take the rates from the other bank. You wanted to buy, the other bank will sell, ask rate 66.32. So 66.32. Now you can clearly see the selling rate is higher than the buying rate. So there is a little profit of 52 paisa. So almost the loss has been recovered. Now, apart from that, the loss of the profit is this. How much was the profit that the company was expecting? 0.16. This was also lost. Now there are three things that the bank should recover: 0.16, 0.52 and 0.53. This is also minus. So the total of all these three is 0.16 plus 0.53 minus 0.52. So around 17 paisa. But in exam, you have to do the calculation on these two rates. That's it. That will result into 17 paisa loss. 66.32 you can see is an outflow. We are buying at 66.32 and selling at 66.15. That's a loss of 17 paisa. That will be called as a swap loss into 50,000. That's 8,500. So by recovering 8,500 under swap loss, we will recover the profit and this early, or we can say the cancellation charges on the cover cancellation and the swapping agreement as well. Let's have a look on the final answer now, one by one. So do you agree with this 47,250 of the cancellation charges? Let me just go through it. That 47,250 of the cancellation charges. Apart from that 8,500 swap loss. Apart from that 26,500 on interest, that comes to 17. So these are the three charges to be recovered in all the three cases. So the total cost is cancellation, swap loss and interest. And total comes to 55,767. Now, very first thing. Let me come to this point. If the customer wants to cancel, he will pay 55,767. That includes cancellation charges, swap loss and interest. And he can go home. But if he wants to execute, that means he wants to buy. He will buy it at spot. So first he will have to make the payment of 55,767. Okay. And after that, spot selling rate will be applied to the customer because he wants to buy today on 12th of the September. So spot selling rate is 65.99. Let me just check once again. See, I told you 65.99 the ask rate, and in the new rate will be 66.49 later on. So 65.99 at this rate he can buy today itself. Add margin 0.10%. See, 65.99 add margin, the rate will be 6.0560, which will be rounded off to 66.0550. Now apply that rate, 66.0550 into 50,000. That's 33,02750. Pay this much of the amount and get the delivery if you want it. Otherwise, cancellation charges to applied. So even if you cancel or deliver, this much of the amount to same. Or even if you extend, this much of the amount to same. 55,767. That means all the previous things has to be cancelled first before doing anything new. And the new rate will be applicable. The new rate. How did we calculate the new rate? If you want to buy in November and that you are requesting on 12th of the September, so the rate applicable will be, you will buy it, customer will buy it from the bank, bank will sell it. Ask rate 66.49. See, 66.49 and this is the ask rate. Add margin, round it off. That's it. This is the new rate. That's it. The story is over. So what I wanted to say is, whether if you want to execute the contract, buy it at spot. If you want a forward rate, we can give you the forward rate. But in all the three cases, you will have to pay 55,767, which includes the cancellation, swap loss and interest. You cannot avoid that once you make a default. Got it? Last question now in this entire forward contract cancellation before starting the last concept. This is an interesting one. See, this question and the fifth question is same pretty much, but there are three different dates: 4th April, 7th April and 14th April. Now let's have a look. Z has to remit USD $1 lakh for her daughter's education. In the previous example, it was his son's education. Okay, on 4th April, accordingly, she has booked a forward contract. Now tell me one thing. Z has to remit. Now she has to buy the dollars from the bank. That means bank will sell it. The original contract rate of bank with the customer is forward. Do you agree? Forward sell. So bank agreed to sell to Z every dollar at 73.8775. So, and the bank also covered itself in the market with forward buy. This is in interbank market. That means bank will buy at 73.7575. I think the rates are also same, man. Let me just check once again. Seems familiar. Yeah. It's 73 now, and that was 63. 63.8775, 63.7575. Doesn't matter. Let's take it once again now. 10 rupees has been increased. Okay. The bank covered its position. What does that means? When Z came to the bank and she requested her, we can say, desire of buying the dollar from us after some date, which was 4th April 2021. So we quoted her this rate after entering into the buy contract in interbank market. We got to know that every dollar will cost us 73.7575 on 4th April. Let's add the margin and quote the rate to Z. So we made this contract securing ourselves also from any change in exchange rate. And if the contract contract gets honored as agreed, then we will end up making a profit of 12 paisa on every dollar. That means on 1 lakh dollar, it will be 12,000 rupees. So this is the original profit that we are supposed to make if the party does not default. Now, the exchange rate for dollar in the interbank market on 4th, 7th and 14th April. See, 4th April, from that date, 3 days are from 4th April, means from due date, 3 days comes to the end at 7th April, and after that 14th April's date rates are given. Now, exchange margin is 0.10% and interest outlay of fund is 12%. The remitter, due to rescheduling of the semester, has requested on 14th April 2021 beyond 3 days for extension of the contract. Now, even if you extend the contract, you cancel the contract or you execute the contract, the very first thing that you have to do is pay cancellation charges, swap loss and interest on outlay. And if you want to extend the contract on for the due date of 14th June, this request was made by you on 14th April for June month, and you want to buy the dollars from us, we will sell it, ask rate is applicable. We will add 0.10% in that. Apart from that, no data of 14th April will be applicable. Acha, apart from the extension, if the question would have been execution, that means delivery, that means you are ready to buy at spot rate, then this rate would have been applicable. We would have sold it at spot rate of ask quote at spot of 14th April. But only in case of execution or you want the delivery immediately. And this is in case of extension. So only that rate will be used by us. But since you have gone beyond 7th April or beyond 3 days, what will happen? For the cancellation, we are going to use the rates of 7th April. Now, we have a forward sell contract with the customer. In order to cancel this, we on the due date, on 7th of the April itself, because third day gets over on 7th April. So we will spot buy of 7th April, sir. Take the spot buy rate of 7th April with the customer. You will buy bid rate. Bank. You are the bank. These sell buy are from the bank's angle. So 7th April spot buy rate is applicable for the cancellation 73.1575, and you are applying it to the customer. This is a bid rate, deduct margin out of it. 73.1575 minus margin. This is going to be your cancellation rate. Let's have a look. 1575. So 1575. 7th April. Since it is a bid rate, less margin, 73.0843, 73.0850. That's the rounded off rate. Now this rate and the contracted rate will give you the cancellation charges. Contracted rate was 8775. Bank was about to receive this much. Now the bank is buying at this much. And you can clearly see the bank should get more money from the customer. And the amount payable by customer comes to this much. For $1 lakh, 0.7925 is the loss. Cool. The only reason of taking this question is explaining the part where the customer is appearing in the bank after 3 days. Apart from that, all the other calculations are same as discussed in the first question. Let me complete the question since I have started. Now comes the swap point. Easy. This is 7th April. Closest rate we are going to take. Okay. So the cover rate will be here. Customer's rate will be here. And the two new rates will be taken. Now why these two new rates are taken? This first new rate is taken spot on 4th. Spot rate is taken to cancel the cover contract. And this is taken on this date itself to swap. Whether in reality the bank does it or not, but we have to recover it. So we will take it. Now let's write the original rate. Forward sell to the customer, forward buy in cover market. Now we will be buying $1 lakh at this rate. What are we going to do with that? We were supposed to sell it to the customer, but the customer did not appear on that date. We will spot sell in the interbank market. Both of them are in interbank market, sir. So we will sell, the other bank will buy, bid rate is applicable. And since this is interbank transaction, no margin. Spot sell. So bid rate of 4th April. Spot. 73.2775. 73.2775. And you will sell, that means you will receive this much. And how much was the buying rate? 73.7575. 73.7575. So you can see that you are receiving less. There is a loss. You are paying 73.7575 to buy every dollar, and you are selling it in the spot market to the other bank at 73.2775. That's 48 paisa. Again the same loss. Swap transaction. What will be the swap transaction, sir? What will be the swap transaction? It's very simple. You will take it on this date itself, 4th April, to cover that. So first of all, it will be forward because you are taking it 3 days back. And this was sell, to you will take buy. Since you want to buy, the other bank will sell. Ask rate will be applicable. So closest on 4th April, closest forward buy contract, and that to ask rate. Buy is for us. So closest forward contract and ask rate. 3 things to know. On 4th April, closest forward contract and take the ask of it. On 4th April, closest forward contract, take the ask of it. 73.4275. So 73, we are going to buy at this rate, 73.4275. What was the selling rate? 73.8775. 73.8775. Although this may not happen in reality, I am telling you, FedI guideline says that even if the swap transaction is not done, we will assume it as done and entered into by the bank, and we are doing it only to recover the swap loss. So what is the loss in this case? profit of 0.45 and the original profit of 0.12. So 0.12, 0.48 becomes 0.60 minus 0.45 becomes 0.15. So only loss is this much, which you can calculate by taking the difference between these two. 0.15 loss, 30,000, no, 15,000 of the swap loss. See, 4275, 2775. These two are the new rates, spot rate and closest forward rate. The difference between these two. Swap loss 1,15,000. Now interest on outlay. What was the outflow? 48,000 was the outflow. Understand that this 48,000 is included in that 15,000. 48,000 of the loss, 45,000 of the profit, and 12,000 of the loss of profit. All the three are included. All the three are included in that 15,000 loss. Okay, sir. Now interest for 3 days. That's it. 7, because we closed the contract. I think this should be for 10 days. According to me, this should be for 10 days, not 3 days, because the customer appeared on 14th and he is doing all the settlement on 14th. It should be for 10 days. No, this was the first time Institute asked this question, so that might be copy paste would have been done in that, but this should be 10 days. And what will be the new contract rate, sir? New contract rate is given on 14th. Please understand. So on 14th, you are going to look at June ask rate, because customer wants to buy, we want to sell. On 14th April, ask rate 73.7050. Let's have a look. 73.7050 at the margin, because it is ask, and round it off. Simple. The story is over. So what are the questions? Amount payable. Okay, we calculated the amount payable, swap loss, interest, new contract, and the total cost. Total cost will be the total of amount payable, swap loss, and interest. It's the total cost. Okay, sir. Cancellation charges and this. With this, we finish the concept of forward contract delivery, cancellation, and extension. Let's come to the final point in this. It's up here. Everything. See, I have marked yellow to all this late part, because most of the items, we can say all the steps are same in late delivery, late cancellation, and late extension. There are 3 charges which has to be recovered in all the 3 cases. So now you might have understood why we have taken all the different parts in different stages. Like, I did not start and took delivery for all the 3 delivery types in first video, or the last. And now you would have understood that why the sequence of every topic was different. Like 1, 2, 3, then 4, then 5, then 6, and then 7, 8, 9. Because everything was arranged as per their difficulty level. We started with the easiest one to the difficult one. Okay, sir. I hope this will help you a lot. With this, we finish our topics of forward rates, and we are going to move over to the last topic, that is nostro, vostro, and loro account. Please understand, it is not nostro, it's not t, it's tr. So this is basically type of accounts that we are going to learn, and we are going to solve the first 3 questions. Last 2 will be your homework, because the last 2 will be similar to question number 110. Have a look on the concepts now. Nostro, vostro, and loro account. Instead of this, let me just check if we have it in, if we can take it from the regular batch itself. Oh, that was explained in very much detail in that, I think. Yep. Right. See. Select this, copy. paste, delete. Okay, so I will remove this part. It's very easy to understand, like it's simple to understand the nostro, vostro and loro accounts. Nostro, vostro and loro. So these are the three types of account. Let's have a look on them. Let's take the banks in India. This is India. This is America. The bank in India, ICICI and SBI. Okay. The bank in America is Bank of America. Okay. Now understand that this ICICI bank account is there in the Bank of America. This is the Bank of America, and Bank of America has an account of ICICI. So if you are ICICI bank, you will say this is my account in your bank. My account in your bank is called as nostro account. Whatever the my account, your bank situation is, it will be called as nostro account. So when ICICI bank has an account with the Bank of America in America, this account will be called as nostro account. So whenever you say that this is a nostro account, that means that's your account, but the bank is someone else's. Okay. Now from the Bank of America point of view, this is my bank but your account. Your account in my bank. From the Bank of America's angle, the bank is mine, but this is your account. So the same account is vostro for Bank of America and nostro for ICICI bank. If the account is yours, it's nostro for you and vostro for me. And that account should be in my bank. Got it? ICICI's bank account in Bank of America is a nostro for ICICI and vostro for Bank of America. So same account can be nostro, can be vostro and can be loro. So these three are not different account. The difference is the party, is the entity. If you change the entity, the name will change, account will remain same. Now if SBI wants to use the ICICI account of Bank of America to settle some transaction in America, so SBI will take the approval from ICICI bank. So what the SBI is going to say to the ICICI bank, SBI will direct or will give some instruction to the ICICI bank that from your nostro account, you pay this and this party in America, this and this amount. So basically SBI is using ICICI bank's account in Bank of America to pay to someone else in America. So for SBI, this account is your account and the bank is also their bank. So neither the account is mine nor the bank is mine. When the account is someone else's, the bank is also someone else's, we will call it as a loro account. When both of the account and the bank is not mine, it's a loro account for me, and still I'm using that account for some transaction. I'm taking the help of the ICICI bank's account. So this account is nostro for ICICI, vostro for Bank of America and loro for SBI. It will take some time to get these things into your head, but it's very easy, sir. If the account is mine, bank is your nostro. If the bank is mine, account is your vostro. And if the bank is yours, account is yours, loro. Okay, sir, that's the main thing. And now I think we are going to shift for the questions. That's it. Theory question can be asked on this. The basic understanding was required. Question number 108. This is related to the cross rates, but you will have to understand it from the point of view of nostro, vostro and loro. XYZ bank is in Amsterdam, wants to purchase. Amsterdam means what's its currency? Euro. It's in Europe, na? Netherlands. But it wants to purchase 25 million against pound, not euro. See, there are three currencies involved. Its home currency is euro, but it wants to purchase 25 million rupees by paying pound for funding their Nostro account. For funding their Nostro account. Now you have to create a history for this. And they have credited Loro account of Bank of London. In Bank of London, you can deposit only pound. And if you have to buy this 25 million rupees, that will go into Nostro account because Loro account is with the Bank of London. So Nostro account will be somewhere in India. Somewhere in India. So let me create a situation for you. Amsterdam. Let's say this is India and this is like ICICI Bank and this is London, Bank of London. Okay. Whose account is this? This is the account of XYZ Bank. Now, can I call it from the Amsterdam Bank's angle? That means XYZ Bank's angle. This is my account in your bank. So that's a Nostro account for me, right? Nostro. Okay. Now, there is another account in here. And understand, they have credited the Loro account. So, who have credited? XYZ, obviously. XYZ Bank paid or credited some amount in pounds to this account, which is called as Loro account. If this is the Loro account for XYZ, it means the account is not of XYZ, nor the bank is of XYZ. So we are pretty much sure that the bank is of London. And whose account is this? This account is ICICI Bank's Nostro account. Now understand, the same account is Loro for XYZ Bank because neither the account is of XYZ Bank nor the bank is of XYZ. So this account is Loro for XYZ and this account is of ICICI Bank, so it will be Nostro for ICICI and it will be Vostro for Bank of London. Okay. Now what is the situation? XYZ Bank asked the ICICI Bank to credit 25 million rupees in its Nostro account. This is the account of XYZ Bank in the ICICI Bank account. So they said that please deposit, they said to the ICICI Bank that please deposit 25 million rupees in my account with you. XYZ Bank told ICICI Bank to deposit 25 million rupees in my account. This is your account. This is my account means this account is of XYZ Bank. And obviously ICICI Bank is ready to deposit 25 million rupees in this account. But in return, they also need something. So XYZ Bank said that in return of this, I will give you pounds and that too in your account of Bank of London. So XYZ Bank credited pound. So in return of this, XYZ bank credited pound in this account. So practically whatever will be deposit in this account is of ICICI. So if XYZ is making a payment to this account, ICICI can make a payment to this account. So practically ICICI is giving something to XYZ and XYZ is giving something to ICICI, but in two different accounts. That's it. That's the story that this was asked to do. And for this, XYZ did this. That's it. Simple enough. Okay. That was just a story, but now we need GBP INR rate. And if there is a bid and ask problem, then it will be a, yeah. So, XYZ bank wants to purchase rupees. So, XYZ wants to buy rupees, that means sell GBP. Now you can calculate or take any kind of a cross rate. INR GBP, GBP INR, both will work. Okay. I am going from the angle of GBP INR. So if I go from the angle of GBP INR, I want to understand. This bank wants to sell GBP. The other bank will buy GBP. So what rate will be applicable? Sir, bid rate will be applicable. I need a rate of bid because I want to sell GBP. GBP is the base currency, na? Or you can take ask rate of INR GBP. This is very easy for you to understand. You want to buy rupees, other bank will sell rupees. Rupees is the base currency, other bank will sell rupees, ask rate. So you take any, you will get the same answer. So let's start from the ask INR GBP. I think that is where you are more comfortable. What will be the cross rate? Sir, ask INR USD, Euro, and multiplied by ask Euro or which currency? I think it's dollar. So it will be USD itself. I was right. USD. And ask of USD GBP. Am I right? Whenever you frame a cross rate situation, the first currency should be put first and the last currency should be put last, and in between the common currency. Now, you need to first understand whether the rates are given like this. Like in the first quote, the base currency is INR. In the second quote, the base currency is USD. If the quotes are given exactly like this in the question, then you can take the values. Otherwise, you will have to convert them into the reverse base currency. So let's just see if INR and USD is the base currency. See, here GBP is the base currency and here dollar is the base currency. So both the rates are opposite. Both the quotations are opposite. So what are we going to do? Simple. Reverse both the quotes. One by bid of USD INR. Now we can pick the rate. 1 by bid of GBP USD. Now we can pick the rates. So bid of USD INR and bid of GBP USD. Let's take the bid rate. This one and this one. This is very important to understand the base currency. Without knowing which is the base currency, you may end up taking the wrong quote. 61.3625. 1 divided by 61.3625 into 1 divided by 1.5260. It comes to 0.010679. Yeah. So this is what GBP per INR. GBP per INR. This much of the GBP you will have to pay per INR. How many rupees you want to buy? You want to buy 25 million. Just let me check. 25 million rupees. So multiply it now. Because this is GBP, this is rupees. Both the currencies are opposite. 0.010679. That comes to 266,975. Even if you do it from this part now, you will get the same answer except for the rounding of differences. Let's have a look. Bid of GBP, then the second common currency USD, and bid of USD INR, and both the rates are same, bid. So it will be 1.5260 multiplied by 61.3625, 93.639175, or if you round it off to 4 digits, there will be some rounding of differences. So this is rupees per pound, and now you need 25 million rupees. Am I right? So both the currencies are in rupees. Divide it. 25 million divided by 93.6392. That's around, just a second, 25 million 93.6392, 266,982. So both the rates are same, hardly a difference of 7 pound, right? Let's do that. Where is the answer? 267,500. Alagi tangent. So what they did is they just calculated the reverse of everything, I think. Yeah, here 1 divided by 1 divided by. Never do this. 1 divided by 1.5260, you rounded it, like this was rounded off, this was again rounded off, both of the currencies have been rounded off. You ended up 267, I ended up at 267,500. You can try calculating, this is the most appropriate answer. 400 or 500 pounds of difference is there because of this 6, 8 and 7. Why I didn't get any rounding of difference here? Because I did not write it as 0.01068. What did they do? 0.0107 directly, not 68. I took 2 more decimals to get the proper answers. So it all depends upon the decimals that you are taking. If the question is very much clear about the 4 decimal, then it's all fine to do like this. Question number 109. This is also a cross rate calculation question. In this case, you will be buying 15 million against the dollar for funding their Vostro account. Now, ABN AMRO Bank, Amsterdam, wants to purchase 15 million against US dollar for funding their Vostro account. Earlier they wanted to fund their Nostro account, but now they want to fund their Vostro account with Canara Bank, New Delhi. Okay. Assuming the interbank rates of dollar is this, what would be the rate the Canara Bank would quote to ABN AMRO Bank? No cross rates. Further, if the deal is struck, what would be the equivalent dollar amount? ABN AMRO Bank Amsterdam wants to purchase 15 million against dollar for funding their Vostro account with Canara Bank, New Delhi. It is as simple as it is. So they want to purchase rupees, sell dollar. Dollar is the base currency. They want to sell it. Bank will buy it. 51.3625 should be the rate. What else? See, now I am just waiting. Why? Like what is the trick in this question? This cannot be that easy. See, you wanted to buy rupees. That means sell dollar. And if you will sell dollar, bank will buy dollar. Dollar is the base currency in the quote. So if bank is buying, take the bid rate. That's it. This is the answer. Okay, come over to this part. This is an interesting part. Let's skip the question number 110. I think we can take the larger one out of all this. I think second one is okay. Second or third. All the questions are almost same. Let's take the last question, 112. I think this is little difficult. Other two are very easy. The first one has no extra information. That's why I skipped that. Question number 112. You as a dealer in foreign exchange have the following position in GBP. See, you as a dealer in foreign exchange have the following position in GBP on 31st October 2019. Balance in the Nostro account credit 2 lakh. You are sitting in some country, let's say, not, let's say you are in India and your account is there in London. That's a GBP account and that's your Nostro account. And you have a balance of 2 lakh GBP in that account. Okay, sir, let's start. So there are two things that we are going to create in question number 112. First is the statement of foreign currency, and that too only GBP. This is just a statement which will show your position, purchase position and sales position. It may not convey the actual cash flow. Yes. So if I write something in this purchase or sales column, it may not mean that we have actually purchased it and the cash has gone out, or we have received if there is a cash outflow or inflow. No. Even if I take a forward buy contract, I will write that amount in purchase column, and forward buy means just a contract, not a real cash flow today. Okay, so that's just a statement of your position in foreign currency. It's better to write up it as a position. Okay, and here I'm going to write Nostro account. This is a proper bank account, man, where we will have some debit and credit balances. Okay, we started with the opening balance of 2 lakh GBP. This is the Nostro account in GBP. So we have a balance of credit of 2 lakh. Opening position overbought. Now this is just a position in GBP that, let's say for example, there is a register. Okay, there is a register, and when you close it, when you open the new register, what are you going to do on the first page? You are going to write down all the total of all the previous positions. So total of buying, total of selling, and the net position is overbought or oversold. So the net position is purchase or sale. That's what you are going to write down. So it's like this: opening overbought. Since it's an overbought position, we will write down it in a purchase column, 1 lakh GBP. Purchase a bill on London. You are a bank dealer and you have purchased a bill on London. Whether it's you purchasing a bill doesn't mean buying the currency. It may also mean selling the currency as well, but you need to understand the meaning of it. You have purchased a bill on London. That means this is you, dealer. This is exporter. You are a dealer. He might have sold some goods to a party in London. So he have raised a bill of around 1,60,000 pound. So practically speaking, this party in London should pay to the exporter. Now the party will pay after 60 days or 90 days after the credit period is over, but exporter needs the money urgently. So exporter comes with this bill to the bank and sells this bill. Exporter is selling this bill to the dealer and dealer is buying this bill, purchased the bill on London. So practically buying this bill means now this party will pay the pound to the dealer and we will convert that amount automatically. This will be paid, let's say, after 90 days. and this is paid at today itself. So whatever the bill amount is, we will discount it, convert it, and we will pay it to the exporter in rupees. So we are giving only in rupees to him. So let's talk about the 1,60,000 pound. Is that 1,60,000 pound coming into the dealer's account or going out of the dealer's account? It's coming in. It's a sales receipt which the exporter was about to receive. Now we are going to receive. So purchased bill is a sales item, sir. Okay. That means sales item means sales. We are not selling the currency. We are buying the currency. 1,60,000 pound. Not just because purchased word is written there, right? You should understand the meaning of it. Purchased a bill. And because of that, we are going to buy pounds. Actually speaking, we bought the pounds and sold rupees. We bought the pounds and sold rupees. But these pounds are yet to be received. 1,60,000. Now you might ask that why I am not writing this transaction in Nostro account. It's very simple, sir. This is just a bill purchase, not an actual cash flow. So we have created a purchase position, but the cash flow is yet to happen. This is a real bank account and it will get debited and credited only when the real cash will be coming into the account or going out of the account. When the cash will be deposited, it will be credited, and if the cash goes out of the account, it will be debited. But real cash flow should affect this account. Apart from that, all the positions can be written in this statement. Sold forward TT through a telegraphic transfer, that means online mode, you have sold GBP. But this is not a real cash outflow. This is just a forward contract that you have made. That means you have promised to someone that after 3 months, I will transfer 1,20,000 pounds to you. So pounds are going out, but not today. It's not a real cash flow today. So sold, write down, sold forward TT, telegraphic transfer, 1,20,000. So we have created a sales position. But trust me on one thing. If the words are only sold TT then it will affect the position column in the same manner, but also the Nostro account, because sold TT means this is a real cash outflow also. Forward purchase contract cancelled. When you create a forward purchase contract, you add it in a purchase column, but when it gets cancelled, you will write it in sales column. 60,000. Forward purchase cancelled. Where are you going to write? 60,000. Now you might ask that if the cancelled contract is written here, where is the original contract? See, forward purchase contract might have been entered in the past in some other register or whatever it is, in the last month also, and that balance is already carried forward here in 1 lakh. So let's assume that the entry of the forward purchase contract was made earlier and that contract is now getting cancelled. So 60,000 wrote under the purchase column is now cancelled by writing again under the sales column. Remitted by TT. Let's say this is the transfer, online transfer, and you have really transferred 1,50,000 pound. This is not a forward contract. This is a real cash outflow. There is a cash outflow of 1,50,000. And when the money is going out, you will write it in sales column. Remitted by TT. Telegraphic transfer 1,50,000. Am I right? And this is since a real cash outflow, we will write it here as well. So when it actually affects the cash flow then we will write it. And since it is going out, the balance will reduce in the Nostro account by 1,50,000. Do you agree with this? Okay. Draft on London cancelled. Now what is this? First of all, you need to understand when you issue the draft, what happens when you issue the draft. When you issue the draft, it means you are actually selling the currency. Let's say, for example, you are a customer, this is a bank, and you came to my bank to create a draft. So you paid me $10,000, 10,000 rupees in cash. I will talk in terms of rupees only. So you paid me 10,000 rupees in cash and requested me to create a draft of this 10,000 rupees. I did something in the computer and took the printout from the printer. So let's say this is a draft. Now I am presenting this draft to you. This draft is given to you means I am actually giving you 10,000. I am giving you 10,000 rupees. This draft has a value of 10,000 rupees. So whenever I give you the draft, that means I am giving you the money. This is not a real cash flow, but this is a alternative method of a cash flow. So you paid me 10,000 rupees in cash. The cash got affected at that point, but I am giving you the draft now. So basically I am selling the currency. But when you issue the draft, you might have entered it in a sales column. When you issued the draft on GBP, that means you are giving GBP to someone in terms of a paper, promissory note, in which it means that whosoever will present that draft somewhere in other city can get the money. It's as good as check. When you issue the check, that means you are making a payment, but the real payment will happen or incur only when the check is presented in the bank. So the cash flow will not get affected with this. Draft issue means selling GBP. You might have entered that in sales column in the past, but now this is cancelled. So how to cancel something which was written in sales column? Write it in purchase column. Draft cancelled 60,000. You will write it in, just a second, it is getting updated. 60,000. Now do you understand this? Why I am writing it? When I issued the draft, I might have wrote it in under sales column because it was as good as selling the money, but it was not affecting the cash flow. The cash flow does not get affected unless and until the draft is presented back. Forget about presenting the draft, it got cancelled, man. So I will write it in sales column. That's it. Now, purchase column. On cancellation, I will write it in purchase column. On issue, I will write it in sales column. Now let's do the total of this. 1 lakh, 1,60,000 and 60,000. So the total is around 3,20,000 on the purchase side and 1,20,000, 60,000 and 1,50,000. So the total is 3,30,000 on the sales side. Can I say that I have oversold position in this statement because the sales column is higher than the purchase column by 10,000 GBP. So I have oversold position. Okay. And if you will look at the Nostro account, you can clearly see that we have a credit balance of 50,000 GBP. So 50,000 is the closing balance in Nostro and 10,000 is the oversold position. Okay. Now what is the question asking us? Decides the steps would you take if you are required to maintain a credit balance of GBP 65,000. How much is the current balance of GBP in Nostro account? 50,000. How much balance is required? 65. How much more money should be credited? 15,000. Look at this. 15,000 is required to be credited in the Nostro account. And only then we can say the closing balance is 65,000 and then we can close it. The closing credit balance is written on the debit side just to tally both the sides. Okay. Now question is asking you what step would you take to add 15,000 in this bank account? Okay. One more thing. 65,000 GBP nostro and keep as oversold position of GBP 20,000. So the oversold position of GBP 20,000 is required. Okay. First thing first, let's create the balance. Let's make the balance of nostro account as 65,000. Simply do one thing. Buy spot. Buy GBP at spot today itself. So the moment you buy it, you are affecting the cash flow. So 15,000 will be credited in the nostro account, but it will also get credited by spot. That means you are purchasing the GBP. It will also affect the statement. Now you can see we have a overbought position of 5,000 GBP, but we need oversold position of 20,000 GBP. How are we going to do that? It's very simple. Sell forward. Do not sell spot. If you sell spot, this will also get affected. Spot sells means selling spot means cash is going out today itself. Spot transaction will affect the cash flow. If you really want to affect the nostro account now after doing everything that is required, it will be a foolish thing. So sale is required but not spot. If you write down the sale spot now, this account will get tallied, but it will also affect the nostro account in a debit side. You don't have to change it now. This was only required to create a balance of 65,000. So we bought GBP at spot, which affected the position also. So by buying at spot, we affected the nostro account as well and the position also because it was spot. Now we want to only put an impact on the statement itself, that to oversold position. How much? Right now we have overbought position of 5,000. We need oversold position of 20,000. So I would request you to go for sell forward position of 25,000. Now if you will do the total, you will realize 3,35,000 is the purchase total and 3,40,000. Just a second. 335 and we need 355. And you can, this is the total, and you can see oversold position. We have an oversold position of 20,000. See, now both of them are tallying 355, 355. This is how. If you would have written sell spot 25,000 it would have affected the debit balance also. We would be required to write down debit of 25,000 also, because spot transaction will affect the cash flow. So in order to bring the cash flows to the required level, the question asked us to keep the balance of 65,000 in nostro account. So affecting the nostro account means affecting the real cash flow. So we bought at spot. If we buy at forward, nostro account doesn't get affected. And we bought so much of the amount so that the total balance will become 65. We could clearly see that the difference between these two is 50,000. How much more is required? Only 15,000. So 50 plus 15, 65. So this is one transaction. But the moment we entered, we bought the GBP at spot, it affected the nostro. The nostro account the objective of the nostro balance got achieved, but it also affected the position, which resulted into overbought position of 5,000 GBP. And we wanted oversold position of 20,000 GBP. So first 5,000 of that and 20,000 of the oversold position. We sold 25,000 GBP in forward market, so that it affects only the statement and not the nostro account. So the second item or the second transaction that is required is this: sell forward 25,000. What is the answer to this question, sir? Answer to this question is only two statements: buy spot 15,000 GBP, sell forward 25,000 GBP, because only then the total balance will be according to the question, like the total balance in the statement and in the Nostro account will be according to what the question is asking. Got it? Let's have a look. See, buy spot TT GBP 15,000 and then sell forward GBP 25,000. That's it. This is what you have to do in order to keep the balance as required under both Nostro account and the position. So this is what the previous two questions are. Now, see, in this question, in question number 111, everything is like this. And I think we have covered everything. DD purchased. If you purchase the demand draft, basically you are going to write it in purchase column. Purchased a bill, write it in purchase column. Sold forward, write it in sales column. Forward purchase contract cancelled. When you entered into forward purchase, it was a purchase column. Now you will write it in sales column because it got cancelled. Remitted by TT, again sales column, but also will affect to Nostro account because this is a real cash outflow. Draft on London cancel. When you issued the draft, it was written under sales. Now you are going to write it under P, purchase. So 12,540 and 15. 12,540 and 15. Right? Everything is right. And then at the end, you have to keep the balance of 7,500 in Nostro and overbought position in this. Whatever required is, you can do it. If you have to add or less the balance in Nostro account, add the balance in Nostro account or remove it, you can just sell spot or buy spot. Whatever you want to do in Nostro, go with the spot transaction, and whatever you want to do in the statement only, go with a forward transaction. That's it. Okay, sir. The previous question, question number 110. What must you do to square up your position? See. First, we will write down everything and we will find out the balance, which is 364,280, which is the overbought position. Question is saying square up, means close the position. Do not keep overbought or oversold position. Since the dealer has overbought position, it will sell this amount nearest to 3,64,000 because it has to buy in interbank market where the deals are available in rounding off, whatever it is. You have a overbought position, sell it in the forward market. That's it. Close it. Nothing else is required in this question now. With this, we finish the Forex chapter, sir. Everything has been covered. I think no questions has been left for the end. 112 questions. We have covered the most of the questions. I hope you are satisfied with the concepts. What should I say now? This is one of the biggest chapter. I enjoyed solving each and every question. More than you, I enjoyed it. And I'm tired now, obviously, but I enjoyed everything. I love Forex. Out of all the chapters, if you will ask me to select one, I will go with the Forex. That's it, sir. Next chapter is International Financial Management. We have big questions, large questions, huge questions in that chapters. In total, there are 18 questions. Obviously, there will be some homework. There will be some questions that we are going to solve, but we will finish that chapter in 4 or 5 hours, mostly 2 to 3 lectures, mostly. So we'll meet you in the next chapter, sir. International Financial Management. See you till then.